Hello students, welcome once again to the online class and welcome to class 11th accountancy course. Well students, we are continuing with the basic terms of accounting from Unit 1 Evolution of Accounting and Basic Terms of Accounting. Today we'll learn the 9th point, purchases. The term purchases is used only for the purpose of goods in which business deals. In case of manufacturing concern, goods mean acquiring raw materials for the purpose of conversion into finished product and then sale. In case of trading concern, goods are those things which are purchased for resale. Now students, the word purchase is used for those goods in which the business deals, either as raw material in the manufacturing concern or as the goods purchased for resale in the trading concern. Now let us take an example. You are a furniture dealer and you purchase raw material like wood, plank to make the furniture. So that will be called as purchase because you are regularly dealing into the product furniture. And even in trading concern, when you are purchasing ready-made furniture for resale purpose to sell it, that will be called as purchase. When you purchase that furniture, we will call that as purchase. But if you have purchased a furniture to be put in your office or in your showroom to make your customers comfortable, that will be called as asset because you are buying that furniture for earning profit or money. With the help of that you are earning money. So in future, so that furniture which you are not purchasing for resale will be called as asset. But if you are purchasing anything for selling purpose, which or regularly deals in the business for selling purpose, that will be called as purchase. The term purchase includes both cash purchases and credit purchases of goods. Now purchases can be in cash, you give goods, you take cash, or credit purchase like in future you will receive the payment, or nowadays even you have the advance payment, like when you purchase goods from the manufacturer or the seller, you do the advance payment before the goods are available to them. You pay them money so that they will provide you with the goods. Now another term here we have is purchase return, return outward, when goods purchased are returned to the supplier. Next we have, now here you have purchased goods from different suppliers. Sales means transfer of ownership. It is not according to the order that you have to customer for a price. The term sales is used only for the sales of those goods which are produced for sale purpose or which are purchased for resale purpose. It includes revenue from service provided to customer. The term sale is never used for the sale of when you purchase. Now what are you doing? You are paying money to the ownership of goods or services, and when there is return you get a price. Purchase for return you get money or return outward. That so means the term purchase goods is for the sale of goods back to the supplier, producing for sale purpose, or again will resale purpose. The money will purchased come into you, and because all the revenue or the goods purchase that you get will receive by providing service to your customer or selling your goods is through the sale of goods and services. Now when you sell an asset which you have used for a long time, maybe 2-3 years you have used the furniture, now you want to sell it, so that will not be considered as sale. Sale is something in which you regularly deal with. Once again, now you want to sell the furniture which you had bought to be kept in your office, so that will be called as sale of asset because that was not meant to be sold or resold. Next we have is the term sale includes both cash sales and credit sales. Similarly, like purchase, sales and credit purchase, cash purchase and credit purchase, we even have cash sales and credit sales. Like when you sell goods, you give goods, you get money. credit sales, they pay you later on. And nowadays even we have the advance payment, they pay you in advance. So that is how sales can be done, cash credit or through advance payment. Now there's a term here, sales return inwards, the goods returned by the customers to suppliers. Now let us look into this. Supplier, now, you have sold goods to your customer. Maybe the customer didn't like the product, then we'll look into the difference between purchase return and sales return. Or maybe now it was not according to the order, dealer. Maybe they had ordered, maybe you have purchased raw material like 5 tables, so you reversed ready-made furniture from 5 different suppliers, chairs, but now because it is not according to your order, or you don't, it is not matching like the material, so maybe the business returns goods to the supplier. Because of this, so you can see the arrow coming this side. So the business is returning goods to the supplier. You have received, so this is called as purchase return or return. But now when this return inward, so in this case, if goods are bought on credit, the accounts payable will decrease. We have learned in previous video, account payable is when goods are purchased on credit, the amount is recorded in your accounts payable, and slowly when the cash has been paid, it has been deducted. Now on the other hand, the customer to whom you had sold goods, now maybe they are not liking the goods because it is not according to the order, or the material is not what they wanted, so now they return it. So sales return or return inward, coming inside the business. So when the customers return good to the supplier, here when the goods are sold on credit basis, the account receivable will reduce. Why account receivable will reduce? Now since the customer is returning back the good, the business will have to pay back the money to the customer. So the chance of earning money now will reduce. The account receivable will reduce. Next we have the goods. Goods includes all those things which are purchased for resale or which are used for producing the finished products which are meant to be sold. So here goods includes those things which are purchased for resale, like furniture, like chair, table. Like for furniture dealer, purchase of chair, table and other furniture items will be called as goods. Or anything which is required for making finished products like wood, plank, which will be called as goods. Stock or stock in trade. The term stock includes the value of those goods which are purchased for reselling and which are lying unsold at the end of the accounting period. So stock of goods are those goods which were purchased for reselling but they are still unsold, lying unsold at the end of the accounting period. The stock may be of two types. The first one is opening stock and the second one is your closing stock. The term opening stock means the value of goods lying unsold at the beginning of the accounting period. The opening stock for the next reporting period is same as the closing stock from the immediately preceding period, whereas term closing stock means the value of goods lying at the end of the accounting period. Closing stock includes raw material, work in progress and finished goods inventory. So here you can see that the opening stock is the goods that is lying unsold at the beginning of the accounting period. Like we have the 2021. So at the beginning of year 20, the goods that is lying unsold is opening stock. Now the opening stock of the next year is same as closing stock. So closing stock is immediately. So if 2021 is opening, so closing will be 1920. So at the closing of 20, the amount of stock that is lying will be exactly what will be your opening stock for 2021. The closing stock means the value of goods lying at the end of the accounting period. Closing stock includes raw material, work in progress and finished goods of inventories. Opening stock is the value of goods available for sale in the beginning of accounting period. Closing is the value of goods unsold at the end of the accounting period. So here are the few differences we can make out from here. Opening stock is the available goods, the goods that is available at the beginning of the accounting period, and closing stock is the goods that were unsold. So closing stock, the goods that are unsold at the end of the accounting period, and opening stock is the goods that are available for sale in the beginning of the accounting period. Next we have is inventory. In case of manufacturing, there can be opening and closing inventory of 4 types. The first one is inventory of raw material. It includes inventory of raw materials purchased for using them in products manufactured but still lying unused. Like you have bought planks, wood, or other raw materials like leather or clothes for making furniture. So these which are the raw materials which you are using it for making a finished product is lying unused. So this is the closing of raw material, and then next year will be the opening of inventory of raw material. Next we have is inventory of work in progress. There may be some goods which are semi-finished, like in manufacturing concerns like textile mills. You have bought cotton and you have converted it into thread or cloth, but still you have not made it into a final product. So these are the work in progress, already made as semi-finished goods. Next we have is inventory of finished goods. It includes the stock of those goods which have been completely processed and are ready for sale but are lying unsold at the end of the accounting period. So there can be some finished goods which is already ready for sale, but at the end of accounting period it is lying as unsold. Next we have is inventory of stock in trade. It includes the value of those goods which are purchased for reselling. So here not only you have in manufacturing concern, but like in trading concern, you have bought goods for resale purpose. So those goods are which you have purchased for reselling purpose is lying as unsold. Next we have is calculation of closing inventory. To ascertain the value of closing stock, a complete list of all the items in godown together with their quantities is prepared. So when we calculate the closing inventory, following goods should be included in the list of inventory. The first one here is cost sent to customer on sale or return basis. So here when you have sent the goods to the customer, or the customer has sent the goods on the return basis, so this will be included in the list of inventory, like sale return. They are returning it back into your inventory. Next we have goods sent to agents for sale but remain lying with them as unsold. Now maybe you have a very big business, so you have dealers and agents to whom you supply goods, and from there the goods are being sold out in the market. So if goods are being sent to agents for selling purpose, but it is remaining or lying as unsold, so these goods also should be included in the list of inventory, because till now finally the goods are not sold in the market. They are just sent to the agent or the dealers for the goods that you deal. The following goods are not included in the list of inventory: goods which have been sold but remain undelivered. So you have sold goods but it is not still delivered to the customer, so that you cannot include in inventory because it is already out of your inventory even though it is not delivered to your customer. Next, what should not be included? Goods purchased and received which have not been recorded in the purchase book. Now, purchase book is a subsidiary book in which you record all the purchase items from different suppliers. So you have purchased the goods, but yet not you have recorded in your purchase book. So unless you know that the good is there, but you have not recorded in the purchase book, so you cannot say that okay, that is the inventory which is not sold. No, only those inventories can be sold or unsold which are recorded in books, subsidiary books like purchase book or sale book. Distinction between stock and inventory. Stock, it refers only to the value of those goods which are purchased for reselling and which are lying unsold at the end of the accounting period. It is a wide term which includes stock also. Thus, inventory includes inventory of raw material, inventory of semi-finished goods, inventory of finished goods, inventory of stock. So, stock is only the value of those goods which you have bought for reselling purpose and which is lying unsold at the end of the accounting period. But inventory, here it says it is a wide term because it not only includes the inventory of stock, but it includes the inventory of raw material, inventory of semi-finished goods, and inventory of finished goods. Next we have is profit. It is the excess of total revenues over total expenses of a business enterprise for an accounting period. Profit increases the investment of the owners. Now profit, now revenue. Revenue is the earnings from the sale, and expense is the cost of goods that you have to incur for making the goods. So profit is whatever excess revenue or earnings you get after minusing the expenses. Loss. The term conveys two different meanings. First, it conveys the result of business for a period when total expenses exceeds total revenue. It may be noted that loss differ from expenses. Expenses are generated to generate revenues, whereas loss do not. So here you can see that loss is when the total expense, when your cost of making goods is more than your revenue. That naturally then you will incur a loss. But if your revenue or earning is more than your cost of making goods, then you will have profit. But don't get confused between loss and expense. Loss cannot help to generate revenue or earnings, but with the help of expense you can earn income, or not say income, we'll say earnings. With the help of expense you can earn revenue or earnings. How? By spending money on expenses like buying raw materials, paying wages, or by buying fuel for the machinery, transportation. So all these expenses help you to earn money from the sale of different goods and services. Next we have is expenses. It is the cost incurred in producing and selling the goods and services. So expense is the cost that you incur in producing and selling the goods and services. Following are included in the term expenses. The first one is cost of goods sold. Second one we have is amount paid for rent, commission, salary, etc. And the third one we have decline in the value of an asset caused by the use of such asset for business purpose. So here expense, the cost of goods sold. How much cost was incurred for making the goods, like how much amount was paid for buying raw material, for buying fuel, how much amount was paid for paying the rent or salary or wages, and the asset that is used for the business purpose. We know that the value of the asset declines. It will not be as new as how you had bought. after 5 years or more, the value of the asset will decline. So this also is the expense of the business. Next we have is expenditure. Any disbursement of cash or transfer of property or incurring a liability for purpose of acquiring assets, goods or services is called expenditure. Now don't get confused between expense and expenditure. Expense, it helps you to earn revenue or earnings. Expenditure is when you spend money to own a property, or we can say to have asset, and then you have a liability. You have to pay money to have those assets or those services. Like you want to have a Wi-Fi service, or you want to have a purchase an asset, so that will be called as your expenditure. Expenditure may be classified into two categories. The first one is capital expenditure. Any expenditure which is incurred in acquiring or increasing the value of fixed asset is termed as capital expenditure. Such expenditure yields benefit over long period and hence return in asset. So here you can see that when you do the capital expenditure, you are acquiring or increasing the fixed asset. And these fixed assets like machinery, or you're constructing a building for extension of your factory building, or you're purchasing a truck for transporting your goods. So all these will give benefit over a long period of time, and so these capital expenditure which increases the fixed assets in your business will be termed as capital expenditure, and it will be written as asset. Second we have is revenue expenditure. Any expenditure the full benefit of which is received during one accounting period is termed as revenue expenditure. Such expenditure does not result with an increase in the earning capacity of the business, but only helps in maintaining the existing earning capacity. So next type of expenditure here we have is revenue expenditure. So the revenue expenditure benefit is for one accounting period. It does not increases the earning capacity, which means that it does not buy a new asset, but it only helps in maintaining the existing earning capacity. Like in capital expenditure, you have bought a machine, so this is increasing your fixed asset, so that is capital expenditure. Now the same machine you are spending on repair of these machine, which will help in maintaining the earning capacity every year. So when you do this expenditure for one accounting period just to maintain the existing earning capacity, that is called as revenue expenditure. Next we have is your revenue. It means the income of a recurring regular nature from any sources. It consists of the amount received from the sale of goods and services provided to customers. It also includes receipts of rent, commission, interest, etc. So here revenue is the income that you get from regular sources, like from the sale of furniture, your furniture dealer, from sale of clothes, your cloth dealer, sale or stationery items, you have stationery shop, or the service you provide, like we have various kinds of service which is provided to the customers, and from there you earn a regular income from these kinds of regular service or goods that you sell in the market. And also it includes the receipt of any rent, commission or interest. Income. Income is different from revenue. Amount received from sale of goods is called revenue, and the cost of goods sold is called expenses. Surplus of revenue over expenses is called income. It can be thus expressed as, so here we have learned about what is revenue. Revenue is the amount that you receive from the sale of goods and services. And what is expense? The cost of goods sold. So here, income cannot be called as revenue. The revenue is total amount that you have received. Like for example, your expense was 10,000 rupees and your revenue, the amount that you received is how much? 15,000 rupees. So here the surplus of revenue, that means your 5,000 rupees is your income. After deducting all your expenses from your revenue, that is what your income is. So when anybody tells you to define revenue, you say earnings from the sale of goods and services. And what is income? Income is the surplus of revenue over expenses. So here in short we can say income is equal to revenue minus expenses. Next we have is your drawings. Any cash or value of goods withdrawn by the owner for personal use or any private payment made out of the business funds. Now even businessmen, they require money to be paid for their personal use or private payment, and so when they take money from the business or withdraw money from the business for such purpose like paying tuition fees or school college fees for their own children, that is called as drawings. Then we have is entry. When transaction or event is recorded in the books of accounts. So transactions like purchase, sale, receiving money, paying money, when it is recorded in the books of accounts, we call it as journal entry or entry, which we will learn very soon after learning few more theories from the chapter. Then we have is bad debts. It is the amount that has become irrecoverable from a debtor. Now students, the debtor is the customer who have bought goods from you on credit. So they become your debtor because they have to pay you money. But maybe there can be some debtors who are unable to pay you money. So this becomes your bad debts. Like you have sold goods for 2,000 rupees to a debtor or a customer, but he pays you only 1,800 rupees. That means 200 rupees will not be, you will not receive or will not be irrecoverable from the debtor. So that 200 rupees will become your bad debts. Next we have is your insolvent. A person or an enterprise which is not in the position to pay its debt. So you have purchased goods on credit from the supplier, you have taken loan from the bank, but now you are unable to pay your debts, or you can say your curse. So that time the person becomes insolvent. Next we have is solvent. A person or an enterprise which is in a position to pay its debts. So a person will be called as solvent when they can pay their debts, or you can say they can pay their all the curse to the creditors from whom they have taken goods on credit. They can pay back the loan. So they are called as solvent. Now insolvent is also called as bankrupt. They don't have enough money to pay their debts. Next we have is your stores. The materials held by an enterprise for the purpose of consumption in the business and not for resale. So here stock and stores, don't get confused. Stock is you keep those materials which were meant for resale or selling purpose, but store is those goods you keep it, those materials which are not meant for resale. Next here you have is your entity. An entity or business entity means an economic unit which is formed for earning income by providing service or selling goods. So the word entity is the unit that is you have formed in order to earn income for selling goods or providing services. Next we have is turnover. It means total sales made in a particular period. So turnover is the total sales. How much is your turnover? 1 crore or 5 crore or 15 crore? How much is your turnover in a particular year or accounting period? Then next we have is livestock, domesticated animals such as cattle or horses. So not only the goods which cannot move is called as your which you use for the business purpose, but even the livestock like domesticated animals like cattle, horse or other kinds of domesticated animals, these are called as livestock. Then we have is your investment. It refers to deployment of funds in shares or debentures of company with the intention of earning a return. So when you invest, you expect a return, right? Like when I say you to invest 100 rupees, so you will expect that you will get in return either your 100 rupees back or 100 plus some rupees as a return for your earnings. Then we have is your goods and service tax, GST. All indirect tax like excise duty, sales tax, VAT, value added tax, service tax, etc. have been merged into single tax known as GST. GST is paid at the time of purchase and GST is collected at the time of sale. So before GST was introduced, you had to pay all the indirect taxes separately. Excise duty, sales tax, VAT, service tax, but now it has become as a single tax, and now one time the seller has to pay at the time of purchase of goods and they can collect it back at the time of sale. So we are over with Unit 1, Evolution of Accounting and Basic Terms of Accounting, and go through this. All these terms are very important. Go through this and we'll meet with a fresh and new unit in the next class. And thank you for watching, and please keep yourself updated by watching the video. Don't miss any class, and if you have any questions you can ask me.